Thank you, friends, for switching on. I'm your host, Spotter Fred. I'm happy to meet you once again. We are doing our sessions, and this series is our study, our normal study in respect to advanced financial reporting. So we are still doing advanced financial reporting. Now, last time, the previous session, we introduced topic 3, and that was assets and liabilities. We need to look at the element of, we talked about assets held for sale. We need to talk about impairment of assets. Don't forget that. I need to remind you that we talked about assets and liabilities. This is topic 3. In this topic 3, this is our second session. The first item we talked about is assets held for sale. Assets held for sale, IFRS 5. This one, we have already done it in our previous session. Today, we want to deal with the impairment of assets. Impairment of assets. That is IS 36. That's what we want to do today. Then 3, we'll also look at exploration of mineral resources. That is IFRS 6. We have not done that. Then we'll also look at employment benefits. Employment benefits is IS 19. Then we look at after employment benefit, accounting for taxes. That is IS 12. Then we look at number 6. We look at financial instruments. That is IS 32, IS 39, IFRS 7, and IFRS 9. So that's what we'll be looking at. We have looked at the first one, so let's look at the impairment of assets. Impairment of assets, friends, when you say an asset has been impaired, that one I'm saying this in reference to the standard and in reference to our study text, the manifested publishers. When you say an asset has been impaired or has suffered impairment, then it means that there's a loss of value. We say that an asset is said to have suffered impairment if there is loss of value for the said asset. If there is loss of value for the said asset, then we said an asset that suffered impairment loss. Now, we need to also look at this IS 36, the applications of IS 36. We have that IS 36 can be applied in many other standards except the following standards. 1, accounting for inventory, IS number 2. 2, accounting for constructions, that's IS number 12. 3, deferred tax assets, a pension fund or employment benefits. There is investment property, IS 40. Biological assets, that's IS 41. rights and insurance contracts, IFRS 4, non-current assets held for sale, and financial instruments. Those, the IS statistics cannot be applied in those standards. Now, let's also look at measurement. Measurement. How do we determine the value of impairment loss? So you should remember that impairment loss is equal to the carrying amount of an asset. The carrying amount of an asset. We subtract the recoverable amount. The recoverable amount of an asset. Friends, remember we say that there is an impairment if and only if the carrying amount of an asset is greater than the recoverable amount only. Now, before I even talk about the carrying amount and the recoverable amount, the definitions of the two, let's try to see how an example for impairment, to determine impairment loss. Let's look at an example 1. Let's look at example 1. Example 1, to identify the impairment loss, just as a startup, we can say XYZ Limited has the following assets with the respective information. We have asset A, B, C, and D. We have the carrying amounts and the recoverable amounts. Required, determine the impairment loss, if any, for each asset. Simple. Let's try to see whether there is an impairment loss so that we understand when we have an impairment loss. So I'll talk about the solution. The solution here. We have the carrying amount. We have the carrying amount. We have the recoverable amount. And we have the asset A, B, C, and D. So we have 400,000, these 350,000. 200,000, these 450,000. 900,000, this is 800,000. 180,000, this is 300,000. Now let's see whether there is an impairment loss. Let's see whether there is an impairment loss. Do we have an impairment loss? We say that impairment loss is when an asset has lost value. When an asset has lost value, like asset A, the carrying amount was 400,000, but the recoverable amount is 350, so it has lost value of 50,000. Asset B, the carrying amount was 200,000, but now the recoverable amount is 450. It has lost value, so the impairment loss is nil. Asset C, the carrying amount is 900,000, but what we can only recover is 800,000, so there is a loss of how much? 100,000. Then D, the carrying amount is 180,000, but we are able to cover more, 300,000. So that means there is no impairment loss. So you have noticed that we only have asset A and asset C with impairment losses. B and D do not have an impairment loss because they have not suffered impairment. There is no impairment gain. So there is no impairment gain, and for B and D does not have an impairment loss. Very important to know that. Now, we'll want to also know some of these definitions, some of the definitions which we have in our books. Definitions, something to do with the carrying amount, just like the previous definition that we did when we are dealing with assets held for sale. A carrying amount is a depreciable historical cost. Carrying amount, depreciated historical cost. In other words, this is the net book value. This is the net book value after taking into account depreciation. The net book value at the reporting date. That's it. So that's the carrying amount, the figure that we need to recognize at the reporting date of that particular asset. And basically, to determine the carrying amount is simply the costs you subtract accumulated depreciation. You take the costs minus accumulated depreciation. Now, how about the recoverable amount? Recoverable amount. Recoverable amount. Recoverable amount is the higher of two values. A is the higher of two values. Fair value less costs to sell. We call it net realizable value. Or B, value in use. Value in use. Value in use. In other words, these are present value of all cash flows. Of all cash flows expected. Of all cash flows expected from the asset. From the asset. And the fair value less cost to sell is simply the net realizable value, simply the market value less the expenses we are likely to incur in order to sell that particular asset. And that's it. That's how, those are the definitions of the two. Now, you know, when you talk of the value in use, that means that we have to discount our cash flows. We have to discount the cash flows in order to determine the value in use, in order to determine the value in use, which will be the higher of, the recoverable amount, which will be the higher of the fair value less cost to sell and the value in use. Now, we'll want to look at an example. A simple example, just a simple example of one asset. We say that asset A has the following details. We have the costs. The cost is 600,000. Depreciation rate is 10%. And we have the depreciation rate is 10%. Then we talk about the expected cash flows. Expected cash flows for year 1 and 2 will be shillings 50,000 and 150,000 respectively. The cost of capital is 12%. So we are required to do what? Determine the impairment loss. The impairment loss, if any. The impairment loss, if any. So that's a simple example. So the impairment loss, if any. So how do we go about it? First, on that note, we notice that we can compute our depreciation. The costs of the asset, we are assuming that is the costs. So first, let's determine, our impairment loss. Our impairment loss is simply equal to the carrying amount you subtract the recoverable amount. So what is our carrying amount? Our carrying amount, we are going to have the costs, which is 600,000. We less the depreciation. That is 10% of the 600,000, and that comes to 60,000. So if you subtract that, you're going to have 540,000, like that. That's now our carrying amount. Then we need to determine our recoverable amount. Our recoverable amount, we have our recoverable amount, which should be the higher of a net realizable value. That's the market value less cost to sell. We were not given, is zero, nil. Then we have the value in use. The value in use we can calculate it because it's the present value of the expected cash flows. How will that be? It will be just simply 50,000 by the present value interest factor, that is 12% 1 year, plus the 150,000 by present value interest factor, for that is 12% 2 years. So we can easily get this. We can get the present value. We say our discounting rate in the first place, a discounting rate is 12%, so the discounting factor will be how much? That will be, so we are going to have 50,000 by 0.8929 plus 150,000 by 0.7972. So what will that be? Come and say 50,000 by 0.8929 plus 150,000 by 0.7972. So we have 164,000. Not 164 exactly, is 164,225. After we have done that, we have noticed that we were not given the net realizable value, but we have the value in use, which is 164. So that's what we are going to use as our recoverable amount. And the carrying amount is 540. So automatically there is an impairment loss. So we come and say our impairment loss we have the carrying amount, which is 540,000. We have the recoverable amount, which is 164,225. Then we have an impairment loss. The impairment loss of how much? Impairment loss. There is an impairment loss of 375,775. So that simple is a simple illustration to illustrate how to determine the value in use, because we have no problem in determining the net realizable value, but determining the value in use is simply the present value of the expected cash flows from that particular asset. Now the main concerns for IS 36. The following are the main concerns for IS 36. 1. Identifying impairment. Just identifying impairment. That's our main concerns. How do we calculate the impairment loss? Then we have calculation of impairment, calculation of impairment loss, meaning and also determination of recoverable amount. Remember, we are looking at the main concerns for IS 36. We also have accounting and reporting. Impairment losses. How do we account for that and how do we report? We see identifying and calculation is not a big problem, but when it comes to accounting, maybe that's what we have not done. How do we report it? How do we report impairment loss? Then the treatment of impairment reversals. So impairment reversals. Then we have finally the impairment of multiples. So remember, impairment of cash generating units, and allocation of impairment loss. Those are the main items, not all the items, but the main items we want to deal with. Identifying, we are looking at the factors that you can consider to have concluded that this asset has suffered impairment loss. We have internal and external. Calculation of impairment and determination of recoverable amount, that's not a problem because we have at least introduced ourselves on how to calculate the impairment loss, but we will go into details. Accounting and reporting impairment loss, how do we recognize it? Remember, simple, without even going so details, the impairment loss should be reported in the profit or loss as an expense. Then, and we also have impairment reversals. We may have some reversals. What do we need to do? Then impairment of cash generating units. Now let's start the other items like we have done, like calculation of impairment loss, that's no problem. Let's start with identifying impairment losses. Now, there are various ways of identifying impairment loss. We have internal and we have external factors to consider that this farm or this business has suffered impairment. So we have external and internal. We have external and internal indicators. So let's look at the external indication of impairment loss. One, an expected decrease in the assets market values. Two, significant adverse change have taken place or just about to take place in the technological market, economic, legal, and political environment. Three, increased interest rates might decrease the assets recoverable amount. Then four, the enterprise's net assets are valued at more than their market capitalization rate. Let's look at internal indicators. The internal indicators of impairment: one, evidence of obsolescence, damage, or out of debtedness. Two, there is just about to be a material reduction in the use of an asset. Three, evidence that the economic performance of an asset has been or will be worse than expected. Impaired assets should be reviewed at each reporting date to ascertain whether there are indicators that the impairment loss charged in the previous year could have reversed the whole or in part. Four, indications of impairment reversals are the opposite of impairment indicators above. So that is important. You need to know. That's a note. A note to know that indicators of impairment reversals are the opposite of impairment indicators. Now, let's look at external indicators of impairment reversal. External indicators of impairment reversal: 1. Increases in assets of market values. 2. Favorable changes in market, economic, legal, and political environment. 3. Decrease in interest rates. 4. Favorable changes in the usage of the assets. 5. Improvements in the assets' economic performance. Then now let's look at, we said about calculation and measurement. That, as we must have said, is not a problem because we have already looked at that, whereby we have said that determining or calculation in measurement and recognition of impairment loss is simply the difference between the carrying amount and the recoverable amount. And there will be an impairment loss if and only if there is a loss of value. And we have said that the carrying amount is the historical depreciated cost, while the recoverable amount is the higher of the fair value less cost to sell and the value in use. We also have the accounting and reporting. Accounting and reporting for impairment loss. Accounting and reporting for impairment loss. Any impairment loss will be charged to the income statement in the same reading as related to depreciation, e.g. as cost of sales if it relates to plant and machinery, as admin expense if it relates to office equipment or buildings, or as distribution cost if it relates to delivery fund. An impairment loss of revalued asset may be charged to the revaluation reserve to the extent of revaluation surplus. The accounting treatments are: 1. With the amount of impairment loss charged to profit, debit profit or loss account, and credit impairment asset. Credit the impaired asset account. 2. Where impairment loss is charged against revaluation surplus, debit revaluation surplus account, credit the impairment asset account. Let's look at the treatment of impairment reversals. The treatment of impairment reversals. I-6 requires that impairment assets be reviewed for impairment of at each reporting date to ascertain whether any impairment loss recognized in the previous period has reversed, i.e. whether the recoverable amount of an asset now exceeds the carrying amount. If an impairment loss recognized in the previous year is reversed, then the asset can be increased to the recoverable amount, provided that this does not exceed the net book value that it could have been if there was no impairment loss. The related credit will be recognized in the income statement or profit or loss account unless the loss had been charged to the revaluation reserve, this dealing with impairment reversal. So thus debit impairment assets and credit profit or loss account, or debit impairment assets and credit the revaluation reserve account. Now let's look at the impairment of a cash generating unit. Impairment of a cash generating unit. Now when it comes to a cash generating unit, friends, a cash generating unit is the smallest net identifiable group of assets that is capable of producing cash flows as a group. Now I repeat on that a cash generating unit is the smallest identifiable group of assets that is capable of producing cash flows. That is a cash generating unit. Now we may have cash generating unit like 2 of them, 3 of them, 5, 6, 7 like that. So we need to determine the impairment loss from each cash generating unit. Once we have determined the impairment loss of cash generating unit, we can now allocate the impairment loss to each cash generating unit. On allocation, that's where maybe we'll want to explain further. This is where we'll want to explain further about the cash generating unit. So cash generating unit. This is the smallest identifiable group or combination of assets capable of generating cash flows. Now that comes in when even an entity may not be able to generate cash flows on its own, or an asset cannot be able to generate, an investment cannot generate cash flows on its own, but when combined, when put together, then they are able to generate cash flows. That's now a cash generating unit. Now, in a cash generating unit, we must determine the impairment loss. So, 1, determine impairment loss for each unit. Just as usual, impairment loss is equal to the carrying amount, you less the recoverable amount. Then we have 2, after determining the impairment loss, allocate the impairment loss to each unit accordingly. That is, how do we allocate it? Roman 1, write off goodwill in full by the impairment loss. Roman 2, the remaining impairment loss, will be proportionately be allocated to other assets. So proportionately, meaning we are going to use the weights of the respective assets in that cash generating unit. That's simply what we should do when we are talking about a cash generating unit. Now, we'll want to look at an example. Of a cash generating unit. And this one of the questions that was done by an examining CASNEP as an examining body around December 2009. This was a question, it must have been a question 5 there, question 4. The question reads, the following information is provided relating to the carrying amount of the assets comprising the cash generating units of Alexo Limited as of 30th September 2009. We have the goodwill, tangible, fixed assets, we have inventories, we have the cash generating unit number 1, cash generating unit number 2. Then we are saying the accountants of Alexo Limited have prepared the following cash forecasts relating to the business operations of the 2 cash generating units. We have the details, that's the year, the number of years, 1 year 1, 2, 3, 4, 5, and 6. Cash generating unit number 1, cash flow. Cash generating unit number 2, cash flows. So we have that. The net realizable value of the net assets of cash generating unit number 1 is 50 million, and that of cash generating unit number 2 is 70 million. The discount rate appropriate to the activities of cash generating unit number 1 is 10%, and that of cash generating unit number 2 is 12% required. Roman 1, the recoverable amounts of cash generating unit number 1 and cash generating unit number 2. Roman 2, the impairment loss, if any, for cash generating unit number 1 and cash generating unit number 2. Roman 3, allocate the impairment loss, if any, between the assets of cash generating unit number 1 and cash generating unit number 2. Now from the required is very easy. We start from the recoverable amount. How do you get the recoverable amount? The higher of either the value in use or the net realizable value. Roman 2, the impairment loss, if any. We simply get the difference between the carrying amount and the recoverable amount if and only if the carrying amount is greater, is higher than the recoverable amount. Then Roman 3, we do the allocation. So we can do the first. We can start with the identifying the recoverable amount. Recoverable amount. So we are saying that is a question that was done in December 2009, question 4A, about impairment loss. Then Roman 1 is about the recoverable amount. Recoverable amount for each unit. You know, there are cash generating units 1 and 2. There are 2 of them. The recoverable amount. You need to recall that the recoverable amount is the higher. Recoverable amount is the higher of net realizable value and value in use. Let me look at unit number 1. Unit cash generating unit. Cash generating unit. We say cash generating unit number 1. Let's look at that. What is our net realizable value? The net realizable value we were given in the second last paragraph, where we have been told the net realizable value of the net assets of cash generating unit 1 is 50 million and 2 is 70 million. So this one we have shillings 50 million. We have taken into account the market price. We have subtracted the expenses we are likely to incur in order to sell, and that's the net realizable value. So what will be the value in use? Value in use simply is the present value of all cash flows that will be expected from this particular asset. Let's just do that. We have the year, we have the cash flows, we have the discounting factor. At what rate? The rate is given at 10%. At 10%, then we get the present value. So we have the year 1, 2, 3, 4, 5, and 6. We have the 8 million. We have the 6 million. We have the 9 million. We have the 10 million. We have the 11 million. We have the 12 million. Then we have the discounting factor. Discounting factor at 10%. Then we need to use our calculator. We need to get, this is 1 plus r raised to n, which is 1.1 raised to 1, that is 0.9091. Then 1.1, we have 0.8264. Then we say equals 0.7513. Then equals 0.683. Then equals 0.629. Then we have 0.56445. Yeah, those are the 6 years. So we calculate that. We say 8 million by 0.90991, 7,272,800. Then we have 6,000,08264. We have it as 4,958,400. Then we have 9 million by 0.7513. We have 6,761,700. Then we also have 10 million. 10 million by 0.683. We have 6,830,000. Then we have 11 million. 11 million by 0.6209. So 11 million, that comes to 6,829,900. Then we have the 12 million by 0.5645. We have it as 6 million. We have 6,774,000. If you add these, all of them, you can say now is 7,800 plus the 4,958,400 plus the 6,761,700, then plus the 6,830. Then we have 6,829,900 plus 6,774. That 9,426,800. So we have the two values now. We have the value in use, we have the value in use, and we have the net realizable value. We have the value in use and the net realizable value. So you can imagine this, that our net realizable value is shillings 50 million. Let me put it in full. And our value in use, is shillings 39,426,800. So the higher. What is the higher? The higher, definitely our recoverable amount will be, for unit 1, will be shillings 50 million. Will be shillings 50 million. We come to cash generating unit 2. We do the same. The same in that our net realizable value is equals to what? We were given that. The net realizable value is given as shillings 70 million. So what will be the value in use? Value in use, we do the same. So we bring in the year 1, 2, 3, 4, 5, and 6. We have the cash flows. We have the discounting factor. Discounting factor this time round is at 12%, not the 10%. Then we get the present value. The cash flows given is that there is 200,000. Is 200,000. No, that is 20,000. We have the 20,000. 20,000 or 20 million. We have the 22 million. We have the 27 million. We have the 240 million, 24, sorry. That was wrong. It is 24 million. Then we have 15 million. Then 30 million. So the discounting factor, which will be at 12%, will be 20 million, 1.12. We have 0.8929. Then, in the best way to always calculate this with your calculator is once the first one you have just taken 1 plus r raised to n, which is 1. That's the first one. The second one, the second year, you just divide it by 1 plus r, 1.12. You get the second year, which is 0.7972. Now, after the second year, friends, you simply press equal. You'll get this third year, 7118. Then you press equal, 0.6355. You press equal, you get 0.5674. you press equal, you get 0.5066. Yeah, that's how to use a calculator. You need to be smart, in using this calculator. 20 million by 0.8929, we have it as 17,858,000. Then we have 22 million by 0.7972, we have it as 17,538,400. Then we have the 27 million by 0.7118, we have it as 19,218,600. Then we have the 24 million by 0.6335, 355, we have it as 15,252,000. Then I have 15 million, I multiply by 0.5674, so I'm getting 8,051,000. Then I'm talking about 30 million, the last one, 0.5066. I'm getting a figure of 15,198,000. Then I get the subtotal here. The subtotal will be the total, that is 17,858. I add 17,538, 400. Then I add 19,218, 600. I add 15,252. Then I also add 8,511. Then I add 15,198. So I'm getting something to do with 93,576,000. That is the total present value of the cash inflows. And this means now we come to the point of identifying the recoverable amount. So we need to determine the recoverable amount. The recoverable amount now, the recoverable amount would be the higher of, as we said, our net realizable value in the cash generating unit number 2 is shillings 70 million. 70 million. The value in use. The value in use, simply the present value of the cash flows, is shillings 93,576,000. So which one is the higher? Now our recoverable amount, definitely our recoverable amount will be shillings 93,576,000. That's our recoverable amount. Now we are done with Roman 1. We have answered Roman 1, the recoverable amount. Now our next business is Roman 2, the impairment loss, if any. Roman 2, impairment loss. Impairment loss, if any. If any, impairment loss, if any. If any, it means not all cases will have an impairment loss. You need to recall that our impairment loss is simply the carrying amount minus the recoverable amount. So we have the two cash generating units. I'll come and say cash generating unit 1, then cash generating unit 2. We recognize the carrying amount for the 2. The carrying amount for the cash generating unit. If you look at the carrying amount which we were given there is a goodwill, of which unit 1 does not have goodwill, tangible fixed assets, and inventories. So there is we don't have goodwill for unit 1, but there is goodwill for unit 2, that is 25 million. We also tangible fixed assets. The tangible fixed assets for unit 1 is 26 million. but for unit 2 is 107 million. Then we have inventories. We have inventories. Inventories we have 22 million. Then we have the 23 million. So what is the total carrying amount? The total carrying amount, definitely this accounts to 48 million. And this, if you look at it, this is 5, this is 5, and this is 155. If I'm not wrong, is 155 million. Then we now less the recoverable amount. Our recoverable amount which we have already identified, the first one was 50 million. The second one is 93 million. Now what will be our impairment loss? The impairment loss here, friends, the impairment loss for the first unit is nil. As you can see, there is no impairment loss. But for the second unit will be 155, 61, 424,000. So that's for the second unit. Second unit has an impairment loss of 61. Now we have answered that Roman 2. So Roman 3 is to allocate. We need to allocate that 61,424 within the cash generating unit number 2. So we come and say allocation of impairment loss. It will only be for cash generating unit 2 only, because that's the one that had an impairment loss. So how do we go about it? We recognize the goodwill because we must write off goodwill in full, then tangible fixed assets, then inventories, then total. So our carrying amount brought forward, the total is 40. This one is 20 what? No, is 25 million. Tangible fixed assets so to 107. Then inventory 23 million. Total is 155 million. Then we less impairment loss. We just write off the goodwill in full. You know, the total impairment loss should be 61,424,000. And we have already allocated 25,000 to our goodwill. So how much are we going to allocate to our fixed assets? How much are we going to allocate to our inventories? So we get this one is now nil. The new carrying amount. Now our new carrying amount then in total must be 93. It must be 93,576,000. It must be 93. So how much will be this and how much will be these two items? So that one we apportion appropriately. So first we write off goodwill as we said, and these we now apportion it. We come and say the balance remaining, the balance impairment loss is the 61,424,000. You subtract the 25 million. So how much will that be? So we have the 25 million. We are remaining with the 6,424,000. 424,000. So then the impairment loss for tangible fixed assets will be, the weight will be 107 million over the sum of 107 million plus the 23 million. Then we multiply by that, that's 424,000. Of course, the other you can get it as a difference, then or you just compute it. Impairment loss for inventory will be the 23 million. You divide it by the 107 million plus the 23 million, then multiply by that 424,000, and you get that. So that will be 107, you divide it by 107 plus the 23 million, then you multiply by that 424,000. So this will be 29,979. Yeah, 979,754. So that will be now 29,979,754. Then you also say 23 divided by the 107 plus the 23, then you multiply by that 424, and that one you get the 6,444,246. So that means here will be 6,444,246. And let's determine the new book value now. 107 million, you subtracted 979,754. We have it as 77, then 246. Then we say 23, you subtract 6,444,246. What do you have? We have 16,55754. So that's what we were required to do, especially the allocation of the impairment loss, which we have allocated accordingly. Now, friends, we come to the end of this session. We come to the end of this question. We come to the end of this topic, impairment loss. And for details or for further studies in respect to impairment, do not forget to refer to our texts, our study text, Manifested Publishers, the new edition. Don't forget there is the old edition and there's the new edition which has been revised for the purpose of the current sittings. So I wish you all the best as you go through the previous sessions that we have been doing together. God bless you. See you next time. Our next session will still be doing assets and liabilities. That's what we'll do next. Thank you. See you then. Your host, Mr. Spotter Fred.